welcome to the latest Master Investor podcast. And I'm delighted, I'm Jonathan Davis, and I'm delighted to be joined today by Konstantin Sidorov, who is the founder and the CEO of the London Technology Club. Konstantin, welcome to this podcast. Why don't you tell me first just a little bit about, before we move on to talk about technology investing, which is the main thing that we're going to be talking about today. Tell us a little bit about your background and how you came to be here in London, where I'm speaking to you.
Thank you, Jonathan. Thank you for inviting me. My background is very simple and straightforward because I started my first business in technology in 1992 in Moscow, and I built a company starting with the 3-person in total till the size of more than 4,000 people and over 1 billion revenue, with geography in over 20 countries. And actually, that's what I did. I started as entrepreneur, then I moved more and more into investment side, and then started in London, the London Technology Club, and that's my background. But everything what I did before, it was around tech, about tech, because it's my passion.
Indeed. Well, first of all, let's talk about the club, because I've been chairman of a club in London myself for a number of years, and this, of course, the clubs are fun places to be, fun places to meet other people, and fun places to entertain one's friends and colleagues. So let's start with that. That's the easy part. What does the club do, and how do you qualify to become a member?
Oh, we're a community of institutional investors, high net worth individuals, family offices, and professional tech investors. We have different kinds of activities. First, we organize a lot of events around tech. We try to show to our members what's going on in tech, what's going on in very traditional sectors of economy and how tech disrupts those sectors. So, for example, we organize events around technology in art, technology in wine, technology in construction, technology in Formula One, and etc. So that's kind of the educational events what we organizing, because I personally believe the more members knows about technology, the more confident they are regarding in terms of investing in tech. And
so if I wanted to join this club, would you allow me to become a member? What do I have to do in order to qualify to become a member, other than pay you some money or pay the club some money? I imagine there is a membership fee, and it's probably not it's not measured in hundreds. It's probably more likely measured in thousands, is it not?
Of course, you should be like-minded people, and we have the veto right for our advisory board. So we try to prevent conflict of interest, and definitely you should be tech investor. You should go through KYC process as everything in this world, because we are FCA regulated company, and so that's why we have now these days have a quite strict procedure in terms of KYC. But the most important that the ideal member of the club should not only take something from the club, she should bring something to the club, because each of our members is specialist and have expertise in particular area. Either it's a tech area, either it's in maybe traditional sectors, maybe it's finance, maybe it's some other kinds of expertise. So because networking is a big part of our activities, and we try to build a diversity of people who bring something very special to the club's community.
So it's a network essentially whereby, as you say, like-minded and people with relevant experience can get together and they can share their knowledge and understanding of the tech sector. But how does that relate to the actual investment activities of what you're doing at the moment? In other words, I might come along to the club, I might pay some money, become a member and contribute to the discussions. But am I then expected or likely to become an investor in one of your technology funds as well? Are the two related? How closely are they related?
Uh, okay, I'll try to start with another side. Club is provides opportunities, and then each of our member choose what kind of the opportunities they'd like to use. Either it's gathering knowledge about club, about tech, either it's knowledge, it's networking with other people to help their own small tech or other project to develop, or to invest into the best opportunity what the club provides. So actually we provide those opportunities, and then each of our members decide themselves either use all of them, maybe some of them, and etc. Regarding your question about investment opportunities, we cooperate with more than 20 different VC funds who also are our members from all over the world, and we try to get these co-investment opportunities from them. Then we have our own due diligence, because we have analytical team who do this due diligence, and then we provide the best projects to our member to co-invest. On top of that, we have our own fund belong to the club, which provide discretionary opportunity to invest for those who'd like just to give money and to rely on our expertise without their own involvement.
Okay, so I get that. So there's two ways you do that. One is you offer them, as you say, direct access to interesting opportunities, and secondly, you give them the opportunity to invest through one of your pledge funds, as you call them.
Yeah, correct.
Which are opportunities that you've sourced essentially yourself, and indeed you're investing in yourself personally, I believe. Is that right?
Yes, it's also a good point, because it's about skin in the game, and I invest about 30% of the funds to the fund. So that's actually, I'm one of the largest investors. And that's why people who join the fund, who join the club, rely on my expertise as well as successful investor. Because I had actually in my career, I had quite a good examples and quite a good investments. I was quite lucky to be one of the investors in Spotify. They invested in Airbnb, in Didi, in Lyft. So I had quite a good successful exits. So many people like to invest where I invest, and that's also the reason why people join the club. Because I would say that invest collectively, it's not so scary like to do it personally, because many people rely on community expertise, expert expertise, and many people like to invest money where, for example, Elon Musk invested or Peter Thiel invested. So that's how it works here as well.
So in that particular case, though, if I can ask this question in the right way, you've obviously been successful in investing in technology, as you said, and benefited hugely from that. So why are you keen to have other people joining you in investing money with you in the fund? In other words, you put in 30%, which is people follow you. What's in it for you if you could, presumably you could do those deals on your own?
That was one of the reasons why I started to build the club, because usually investor, especially investor in tech, has three major problems. If you invest, you usually have your core business, and because investing is just part of what you're doing, and you have no time for proper due diligence, you have no expertise, especially if you're talking about the tech. It's impossible to have expertise even in all segment of tech, biotech, AI, fintech, so many different sectors, and so that you should have a team. to have proper due diligence, proper expertise. And you have no time, usually. And that's why many investors at the end invest in to most annoying people with the best PowerPoint presentation. And the result is quite obvious. So that's that, and this is an issue. Second problem is that for private person, even very wealthy person, is it's very difficult to get allocation in the best companies. So if you are not Peter Thiel or Elon Musk, as I said, no one waiting you as a private individual to be in a cap table of successful, for example, US-based company, because it's not about money when you try to get allocation. It's about some incremental business value added, what you as the investor could bring to the company. And many founders, most successful founders, are looking for these incrementals rather than for your money. So, and it's very difficult to provide this value if you're just private individual. And third, if we're talking about growth stage companies, so the minimum checks start from maybe 3-5 mil. So even for very wealthy people to invest this money into one project is it's a lot. It's a lot, it's risky. So that's why it's a question how to pull money together from different investors, first to qualify it with this minimum check requirement, and put money together to build the portfolio of the companies. So not just invest in one, all of your money. So that's how I came to the idea why I have to build I shouldn't be just a private individual investor. I have to be institutional investor. On top of that, when I moved to London and found that London is the capital of clubs, you would not find any other capital in the world with such a culture. Clubs culture. And I found that there are so many clubs around so many segments, club around space, aviation, wine, cigar clubs, dogs, cats. I even found one club around snakes lover. But I was surprised there were not clubs around technology. And really, because technology, as I said, it's my passion. It's what I did, what I'm doing. And so that I said, okay, why not to bring it together, this clubs culture of London, together with building the investment unit to bring like-minded people who'd like to invest in technology, who'd like to source the best projects in a club. And that's what I did. And that's I think that's answering your question by I'm not doing it alone. I'd like to do it as a community, as the club.
Very good. Well, that is very clear and I think makes a lot of sense. Can you then tell us about the kind of deals that you and your colleagues in the club are looking to make? I mean, where is I know you've talked about your sweet spot, because there are many stages of technology companies, particularly unquoted private equity companies. What is your kind of sweet spot? And if you're making an allocation, what sort of size are you making through your fund?
I'll start with sectors. We are sector agnostic, but historically, our major segment is fintech, probably because we're in London. Then second is SaaS platform, so marketplaces. Then the third one is medtech. Now we're looking for more about AI, because I personally believe that the future of technology is AI, and whatever sector, technology sector you'll take, the AI will be behind of this sector. If we are talking about fintech, AI will be behind. If we are talking about the healthcare, biotech, AI should be behind and will be behind. So that's why I think the AI is the core technology, which is not easy to invest, not easy to find the best companies there. But if you have an expertise, you can do very well in this sector. So this is our future in terms of the sector. So geographically, 65% of our investments are in the US. Then 40% in the UK and Europe, and about 10% is emerging markets. Now we're also going to increase our emerging market share, especially due to the Africa and the Arab world. So MENA region will be one of our priorities. So not a lot, but anyhow, we'd like to increase this geography in company from these regions in our portfolios. In terms of investment side, so our smallest investment was 500K. Our largest one was 5 million, and last year we deployed about 35-40 million US dollars.
And the kind of companies that you're investing in, rather than not just the sectoral basis, but the what sort of stage are these companies at? Is there any typical kind of company you're investing in? Because
yes,
there's a wide continuum.
Sweet spot. Okay.
Yeah.
So
the sweet spot, yes.
Our sweet spot are the companies with a valuation between 100 mil and 1 billion. And I explain why. Because the early stage companies are more risky. It's a totally separate business. When you should invest in 100 companies, then be ready that more than half failed. And so it's much more difficult selective process and readiness to get rid of many assets if they're not fulfilled good. So we don't touch it. Then if we are talking about the pre-IPO companies, that there are many big banks who provide these opportunities to high net worth individuals. If you go to Goldman Sachs, JP Morgan, UBS, whatever, all of them now providing these kind of opportunities in pre-IPO companies. But our sweet spot is exactly the spot where investor needs professionals. So it's very hard at one, very difficult to get access to the best companies in this sweet spot, and you need an expertise how to choose the best one, which would provide the best return. So that's we believe where we can give to our members our expertise. That's why we choose it.
Okay, so now it'll be interesting to talk to you about where we are in technology investing at the moment. Obviously, you don't have to read many newspapers before you read, stories about how NASDAQ has plummeted, how many tech companies, including some of these pre-IPO companies, which are on very rich valuations, have come down a lot in value. What has been happening in your area? In other words, the area of the size that you're talking about. What has been happening to valuations, and what do you think is going to happen to that? Are they immune from what's going on in the wider world of rising bond yields and so on?
So no one is immune. So, and definitely public market connected with private, private connected with public. So maybe we just discussed it internally, and inside of our team and in our investment team, the private market versus public is much more reactive. So what's happening right now in public market probably will see the reaction in private market in 1/4, maybe half a year, because companies raising money once per year. And so that if, for example, they had a very successful round in December on the top of the market, probably they'll go back to market only December this year. So that's why now private market, we don't see too many changes. For example, in Q1, there were just 5% down rounds according in the US. So we don't see anything bad. However, now many investors already very, very careful to deploy their cash, because cash now is everything. So that's why investors waiting for correction in the private market as well, and don't want to deploy capital like they did even in Q1. So are we waiting for the correction? Yes, we will have a correction. The most affected sector would be pre-IPO companies with valuation above 1 billion. And we see already in the secondary market that we have a lot of sales with not a discount what we had for the public market, but already we see 15-20% discount for the most valuable company from private sector. So the question is how long this crisis lasts, or this correction lasts. Either we'll have a recession in the US or will not have a recession. Even if we have the recession, either it's going to be mild recession or it will be severe recession. These are the questions which no one can answer. We can just say that, okay, the probability of this scenario and that, the probability of that scenario is that. So, but that's what we can say right now. And so if it's lost, this situation in the public market lost, for example, year, so maybe some companies who had some rounds in 2021 would even not feel this correction, because investments in tech is a lot about emotions as well. So that's if the investors are positive, as they look at their public stocks that it's raising, that they're rising, they are much more comfortable to invest in less liquid assets. And that's also very important part of the investor's behavior. But definitely summarize it. We are waiting for the correction. Every correction is a great opportunity because we have better access to the deals, to the best companies. We have much more reasonable multiples in valuation. Another point, by the way, that's what we see right now with some of the companies, that before 2021, if company have their round less than 2x compared with the previous round, they consider to be kind of the losers. So no, that's true. That's true. So and average median. I was really impressed by this statistic. The average increase between rounds in the US was 230%. So more than twice, 270, I think, even 2.7 times. Now the companies which are growing at the same pace like they did before, like 100% per year, let's say that. Now they are looking for the next round with 20-30% above the previous round, which means the correction in terms of the multiples almost 50-60% below what they did last year, which more or less correspondent already to public markets. So, but because their pace, the question, either they're able to keep this pace, this is a question. But if they do that, they already, even without down rounds, would keep going, maybe with a slow pace, but still raise money up and up. So, and this is opportunity for investors. That's why I'm very, very convinced about our Fund 3, because now we didn't start to invest from Fund 3. Actually, we did. We invested in just in one company so far, but we have more than 27 million in cash. And we're in a great position. We can negotiate. We can choose the best opportunities. We can select best opportunities. And I'm really, really happy with that.
Right. So there's an upside in every downside, so to speak. And of course, that's a good story. I guess the question then people might have is, if you're investing in your sweet spot area, what is the expected time horizon now to realizing the value of that investment? Has it lengthened effectively because of what's going on in the public markets? You might be getting in more at better prices, but does it actually extend the expected term of your holding?
Yes, you're absolutely right. So originally, we planned that our exit horizon is between 3 and 5 years. Probably now that we would extend it to maybe for 1 year period. But I don't think that would affect to the return. We, as planned, as we provide 25% IRR, we're still going to deliver it to our investors. For example, our Fund 1, we have now above 70% IRR. Okay, taking into account current correction, that would definitely somehow affect our performance of our fund as well. But still, I don't believe that will go below 25% IRR, which is, I think, it's a really the amazing spot for our investors to keep to save money and to generate additional wealth. Because okay, the question is, maybe it's great strategy to keep cash right now, but with inflation above 8%, means to keeping cash mean you're paying 8% every year. Maybe for short-term period, it's good strategy, but how long investor could keep cash without investing it? I don't think it would last long, but as soon as they start to invest, the valuation will go up immediately. Immediately, behavior would change like that.
Indeed. So let me just be clear about these funds. So you've been doing one fund every year. I think that's right. So Fund 1, Fund 2, and now you're on to Fund 3. And tell us about the performance so far. I mean, you mentioned Fund 1, the IRR, and you mentioned your target and what it's doing at the moment. But that may obviously reduce in the current market climate. What do you think therefore, from what you're saying, that the expected returns from Fund 3 should be higher than the ones from Fund 1, or would they be lower?
I think it's a question about the period. So that's one of the advantage to invest for longer period, is to be guaranteed with quite stable return, whatever happened in between. So that's why investment in private market probably now the best investment strategy, because no one doubts that whatever this crisis or this correction, you can call it as you want, that's lost, and then market when go up as soon as the Federal Reserve resolve their first target, which is inflation. They move immediately to the second one to support markets immediately. So that's why I don't believe that that would last long. In terms of our strategy, it could be it's very, very difficult to compare different funds because we have a period of time. It could be good year, it could be not good year, but I believe that's why our target is 25% IRR. We're going to deliver it, whatever fund is it, at least fund 1, fund 2, fund 3, and over the some period of time. And this is our target. I don't want to say that the fund 1 was the best one, the fund 2 maybe more difficult one. It's not true. It's maybe all 1 year period, yes, but it's not correct to compare, because we could have this bad and good years over 5 years period or 7 years period several times.
What has been your experience with the first fund so far in terms of realizations? I mean, there's 2 ways you can realize these investments. You can, well, there's more than 2 ways, but basically there's a choice between you can eventually come to a public market, or you can do a trade sale, or you can do a sale to another private equity firm. What has been your experience so far in terms of that, or are you still essentially holding the same things that you did when you set out?
No, actually, I think that the right strategy is a combination of what you mentioned right now. So, and actually what we did with our fund 1, we had 2 IPOs. We have 1 M&A deal. And we sold one of our assets on the secondary market. So in terms of the secondary market, we did it under the supervisor of the company. It was Revolut, because we invested in Revolut at a valuation 4-point-something billion. And then we sold half of our holdings at the valuation of 33 billion. So that was very, very successful story for us. And we could sell more, but it was my decision that to keep half of it, because I really believe in Revolut. And this is exactly what we are going to do. So maybe, for example, right now, again, it's quite a short period of time, maybe the M&A deals are maybe more, I would say, there should be more M&A deals rather than IPOs. For example, we already have the first exit from our fund 2. For less than 8 months, we sold company, our shares in company, because it was a company. Robin was acquired by big Japanese telco holding Rakuten, and we had 1.5x over 8 months from the fund from the fund 2, and it was our first exit. So which also good during this time, and I think that these M&A deals would be more and more often, at least over 2022, rather than IPOs. But again, that's the short period. Maybe now we have this kind of deals. Next year we'll have another types of deals. Very important for the fund, for the manager of the fund, to adapt the fund strategy to the current market situation. that's very, very, very important to be adaptive. For example, you are right. That's we raise money for the next fund every year, and we deploy capital every year for over 1 year. Now, for example, with the Fund 3, we made a decision that we deploy capital, extend the deploying capital for another at least 6 months, but maybe in another 6 months, to give us as a manager more flexibility in terms of the investing. We don't want to have a pressure to spend our money now. We'd like to have flexibility to choose the best companies to invest in, rather than to have a pressure to put money to somewhere and then to raise new funds. What's the point?
What's the point indeed? Just looking back over your whole career then as in private equity, what has been the proportion between winners and losers effectively? In other words, is it an 80-20 type of thing where, you know, 20% of the investments make 80% of the return, or is it even more extreme than that? I mean, in other words, how important is it to diversify in order to find the winners that are going to deliver most of the return?
Actually, to select proper investment opportunity is the key for the investor. You should select the best companies, and to get access to these companies, to get allocation, because getting allocation is very, very difficult. Even if you know, yes, I'd like to invest in this company, but the company says, no, thank you, I'm 2 times oversubscribed. So this is 2 major tasks. In terms of our failure rate, so we invested over the club existence in probably already about 60 companies, roughly. And we have 1 company which became bankrupt out of 60, and just 1 company which has down round. So I think it's very impressive results. That's my opinion.
Of course, well, that is very impressive by comparison, but I guess it is still quite early days for these funds. We've only been going for 3 years, as you say, in the first case. Can I ask you about the thorny subject of fees in funds? I mean, private equity funds are always sometimes criticized, sometimes applauded for their high fees, given the amount of work that they do. What are the fees that you charge on your funds, and how do they compare to the industry norm?
You know, I would say we're very normal in terms of fees. So we charge 2% management fee. In terms of carry, we charge 15% for the return up to 2.5x. Then after 2.5, we charge 20, and then after 3.5, we charge 25%. So actually, our carry is more flexible as normal. Many funds just 20 whatever returns they deliver. We have a flexible rate, but for those who invest in fund, we provide to be the member of the LTC for free. So let's say the minimum membership fee to be a member of the London Technology Club is 8k pounds. So it's about, let's say, $10,000 US. So if investor invests in a fund which is a minimum 1 mil, mean 10,000k is exactly 1%. So it means that actually the investor pay 1% management fee, because 1 is covering the membership fee to the club. And also we bring a lot of additional opportunities to our investors to the fund. So because many of our investors are not just investing to fund, but also They are investors to co-invest in different companies wages they like more, apart from investing into fund. And we also provide this opportunity. So there are a lot of added value apart from to be just discretionary investor in the fund.
Okay, so as always in these things, you know, you get what you pay for, or you pay for what you get. It depends how you put it. I mean, there has been some high-profile issues recently. I'm sure you're familiar with the story of Chrysalis, for example, where they collected a very large performance fee, and then subsequently the share price has fallen by, you know, 50% or something. That presumably doesn't do your industry any favors, that kind of experience.
Yeah, you're right. You're absolutely right.
Yeah. Okay, so let's end on a positive note. Then, looking ahead, we are in this difficult period of high inflation, rising bond yields, and tech sell-off in the public markets. But what I'm hearing from you is that you don't think that the outlook for those who invest in this sector today is any worse if they're going to stick it out for the 5+ years that you've been talking about. Would that be a fair summary of what you're saying?
No, I think that's even better right now, because the most successful investments, what we did was during the downturn. So that's when the market is in the lowest level. For example, in Fund 1, I mentioned already Revolut. I remember that we invested in Revolut in at the end of March of 2020, just when the lockdown in the UK was announced. And many people told me, Konstantin, you are crazy. That's almost 5 billion valuation, all markets down 30%. What are you doing? You are crazy. And then we sold those shares in 1.5 year period at a valuation of 33 billion. So, and that's a great example of how to invest during difficult time, because you have more opportunities, you have more choices. And the question is, again, it's easy to invest when the markets are going up, because even non-professional householders could buy shares of Amazon, Google, or whatever. And then no one cares if it's go up for 20%, 100%, 80% at the end. Yes, everyone will get the gain, and every investor is happy. Either you're a professional investor or you're a non-professional investor. During difficult time, you should delegate it to professionals, because only professionals could choose where to invest, how to invest, and how to choose the best opportunities. And that's what I'm telling to my club members. So now delegate, give it to those who knows.
So have another glass of wine, have another cigar, and enjoy the moment.
Yes, and don't look at your public stock too often.
I think that's good advice for everybody, actually. Very good advice indeed. Okay, so, well, Konstantin, thank you very much for sharing your insights with us and for your time today. And I wish you well with your London Technology Club.
Thank you. It was a pleasure.